heroes by making a donation today. Please visit davma.org. That's davma.org.
Financial planning is a year-round job, and with 2024 coming to an end, now is the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide may help you understand some key numbers that could affect your planning next year. There are many important topics to review, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, the guide also focuses on the many ways that the government taxes your Social Security benefits. Take the time now to reflect on your current strategy so you can be fully prepared for any adjustments you may want to make in the future. Get your copy of our new guide, Key Numbers to Know for 2025, by calling 800-393-4001. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
As a busy mom, my to-do list is full.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has information to help you and your family live a healthier life.
Visit goredforwomen.org/momlife today.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Marc Fandetti.
Good morning and welcome back to the Financial Exchange. If you were hoping to close out the year with just a little bit of holiday calm in between the Christmas and New Year's holidays, then I've got bad news for you. You might have gotten that yesterday out of markets, but today you've got a strong downward move with the NASDAQ off nearly 2%. We'll be covering a number of different stories today about markets and their volatility in the closing days of 2024. But it is Mike Armstrong, Marc Fandetti, and Ben Kitchen with you on a Friday ahead of the New Year's holiday, one of the last few shows of 2024. Good morning, Marc. Good morning, Ben.
Morning, Michael.
So kicking things off, unless there's anything that's catching your eyes about markets, I don't see anything specifically that tells me why the NASDAQ might be struggling. You've got some AI news from OpenAI. You've got some, obviously interest rate moves that you're seeing out of the bond market. But when you have as little volume as you're talking about on a day of trading like this, I tend to not read. One, you should never read too much into what's a single day with markets and what that might mean. But two, when it's happening on a holiday like this, it's tough to read too much at all into it because there's probably not a whole lot of volume that's driving this thing one way or another. But we'll be diving in throughout the next couple of hours into markets and what we're seeing out there. So stay tuned. I do want to start on this Bloomberg piece regarding the Trump tariff threats. And this has been really most of what people have been talking about since Donald Trump was elected. Certainly there's policy on tax changes, policy on immigration, but from an economic standpoint, the one that seems easiest to implement and most likely, at least in my view, is all about tariffs. And I'm interested to ask both of you. I have heard very little from individual consumers about fear of tariffs and their implementation and what could mean for them. But maybe that's just my group of people that I talk to. Have either of you heard anything from family members, friends, like, oh yeah, I'm thinking about buying a car or a TV, and I'm going to move that purchase forward because I'm worried about what tariffs could look like in 2025? Because I have generally not heard that.
I haven't heard it from anyone in particular, but I just keep seeing it in the echo chamber that is X.com, or formerly Twitter.
Sure. Yeah. Mark, anything on your end?
No, and I don't care what they think,
members?
so it's... Yeah, I discount heavily anything
They may have said
family or
that, but I wasn't
say.
listening anyway. So
They may have
no
mumbled
idea.
something about hardship, blah blah blah. Can you help us out, blah blah blah, and I just moved on.
Yeah.
But honestly, consumers are your typical consumer, not your purchasing manager at a big company, not your treasurer, not your economist, not your financial
Not your listener
journalist,
to the Financial Exchange.
not your financial commentator like we do here, or certainly not your trained economist. They're not plugged in. They might have heard the word tariffs here and there because Trump says it every third word. Tariffs, tariffs, tariffs. What do you do about childcare? Tariffs. What do you do about fentanyl trade? Tariffs. So they're vaguely familiar that he likes them, but I don't think they have the foggiest of what they are. And they could be they could be excused for not knowing because it does get complicated. And journalists do a horrible job of explaining what they are and what their impact could be. And moreover, we've never had the experience of imposing them broadly in a blanket fashion the way that Trump is proposing, if he's even serious. So your head could be spinning in any number of directions for any number of reasons on this.
I would agree. And generally speaking, I don't see much reason for consumers to make decisions about this today because it is largely unknowable. But what you are seeing fairly clearly, and I've been trying to gauge how significant this is, but there's a few measures here that make it seem that, hey, companies globally are reacting to this in some way, shape, or form. Would be global companies who who export products to the United States are saying, hey, I'm going to do anything that I possibly can to get my goods into the U.S. before tariffs are implemented. And I think that's logical. That makes sense. You have certainty about what the tariff rate is, if any, today, and there's uncertainty about that future. But Bloomberg has a piece today where they interviewed the owner of a wine exporter in Germany. They interviewed a furniture manufacturer in China. And, in many cases, you have companies saying, hey, regardless of how much it's going to cost me to rush this into the United States, if I need to fly it rather than putting it on a ship, I want to get this product into the U.S. ahead of implementation of tariffs and at least lock in that certainty before things go into place with the new incoming Trump administration.
Oh, yeah, totally different calculus. If you are, I'll just call it the purchasing manager, or whatever the right job title is, for a big company that relies on imported intermediate goods, like most big manufacturers do, if you have a choice of placing an order now versus 2 months from now, much like people hedge financial instruments using options, this is just a hedge. If there were an option that allowed you to hedge a price increase on a particular good, and indeed you can do that in the case of commodities, but you probably can't do that in the case of, airbag components if you're putting cars together here in the U.S. There's no option contract on that particular intermediate good. So your only alternative is just to buy a ton of it in advance. It's not optimal, but what else? What are you going to do?
What do you think? Do you suppose this shows up? It certainly will show up in Q1 earnings in some way, shape, or form. But it doesn't seem like it would be a massive hit to earnings if companies are saying, "Yeah, we're stocking up on inventory." They likely have the space to do it, and hey, we're warehousing a little bit more inventory than usual. Yeah, that might be a quarter or two hit to things, but assuming that plays out over the course of the year, I don't suspect that investors would react negatively to that.
It should pull some demand forward. Consumers may be reacting, though I suspect they're not as much in the loop because it's on the margin not as big a component of our budgets. But it could pull some demand forward, Mike, and we'll see it show up in inflation for goods, maybe not headline inflation, but when you break it down, there's goods inflation. And there are measures of supply chain stress. This stuff's all got to get here. It's got to come in through ports and on rails and so forth. Yeah. So we may see those measures tick up if people are acting in anticipation of blanket tariffs.
Yeah. Again, it all just feeds into that big giant equation of the U.S. economy, right? You're hoping that interest rates go down. Well, this, even the threat of tariffs.
Sure.
We all know that tariffs ultimately, all else equal, tariffs are inflationary. They raise prices for consumers. But even the threat of those tariffs could have the impact, like we do about inflation expectations, right? When you have expectations that prices are going to go up, you move purchases forward and therefore sometimes cause inflation. If you expect that prices are going to go up because of tariffs, logically, you might pull that purchase forward and buy something that you weren't otherwise planning on purchasing, thereby driving up that inflation rate higher, thereby making the incoming Trump administration struggle a little bit more with the implementation of, the hope for lower interest rates that might not come to pass.
What bothers me is that he and his advisors, maybe it's mostly his advisors, are deliberately creating uncertainty around what he believes and what he's going to do. This is so bad for, no matter what you think of it. You may think he's great. Tariffs are a good idea. Let's stick it to all those foreigners. Let's make everything here. That's a legit argument. Honest people can disagree. But the uncertainty and the drama surrounding all this. One day he's taunting Canada, the next day he's provoking Panama, and the third day, or maybe the afternoon of the second day, he's threatening Denmark over Greenland. All of this creates economic and geopolitical uncertainty, which in turn feeds into capital markets. It creates volatility. None of this is good for economic growth. You could say you agree with all of his ends, and I'm talking Trump now, which we're going to be doing over the next 4 years, presumably. All this uncertainty, Mike, will increase volatility and probably slightly lower returns if we want to bring this back to capital markets. Forgive me, but it's totally unnecessary. The world is uncertain enough.
Let's take a quick break. When we come back, I want to dive a little bit more into the state of the economy that Donald Trump is going to be inheriting. We've talked at length about this, but it is way, way different than the economy he inherited in 2017 when he last took office. Let's take a quick break. We'll talk about that next here on the Financial Exchange.
Wall Street Watch, a full update on the market's performance to date. Weekdays at 10:30 only here on the Financial Exchange Radio Network.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Your lifelong financial plan should always be top of mind, and as another new year approaches, now is the time to review some key numbers that may affect your strategy going forward. Our guide walks you through several important numbers that you'll need to be familiar with for 2025, especially from a tax standpoint. It's called Key Numbers for 2025, and in it, we'll explain marginal tax brackets for both married couples and single filers, as well as information about the standard deduction that'll be pivotal for your financial planning strategy. We'll also explore other areas like the federal estate tax and gifting limits. Call us right now at 800-393-4001 and ask for your free guide today. That's 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. If you're retired or nearing retirement and haven't done your planning yet, you could be missing out on opportunities that can save you thousands of dollars. Cushing & Dolan are experts in elder law and taxation, and they have a new guide out this month called Balancing Asset Protection and Avoiding Estate Taxes. Early estate planning can have many benefits, especially if you want to protect the assets. But there's another big advantage. Doing your planning the right way might also help you eliminate your estate taxes. Learn how to keep your assets in your family and avoid probate. Get Cushing & Dolan's brand new guide called Balancing Asset Protection and Avoiding Estate Taxes. Call right now, 866-848-5699. That number again is 866-848-5699. Or you can request your guide online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Winter is here, so now's the time to start looking at a fabulous holiday vacation, and there's no place better than the U.S. Virgin Islands. Enjoy perfect weather, world-class dining, incredible beaches, and a vibrant nightlife. No passport is needed, and there's no money to exchange. Take your next vacation in America's Caribbean paradise, the United States Virgin Islands. Go to visitusvi.com to book your trip. That's visitusvi.com.
Mark, we've got a piece here about the incoming Trump administration and the state of the economy, and quote Biden's gift to Trump. It's an op-ed from Market Watch here. And before we get in there, I want to just talk about the state of the economy. 2016, 2017 compared to 2024, 2025, and I won't ask you to quote specific statistics because I didn't ask you to prepare for that. But how would you generally describe one versus the other, if you would, here in the state of the economy? Now,
first you got to agree on how we're going to keep score. Does everybody agree that unemployment, inflation, and GDP are the most important things for the most part? The trinity of macroeconomics, if you like. And if you do agree on that, then we can look at each relative to history, relative to when Trump's first term ended, or relative to the future. We could say, all right, we're going to start now. This is how we're going to keep score. And then the numbers are simple: 2, 3, and 4. Remember those. The Fed's choice inflation measure year over year is in the 2s. It's not quite at 2, but it's close, right, Mike? Like to rounding error.
I would describe it as closer to 3 than 2, but nonetheless,
all right. 2 to 3. That's fair. 2 to 3, because I don't think the Fed's done a great job here either. So I'm willing to err on the side of penalizing them. So we're in the 2 to 3 range on inflation. Mm-hmm. Unemployment, 4s, very low 4s. So I'm going out of order here. I said go 2, 3, 4. I went 2 to 4. Back to the 3, which is GDP, real, that is after inflation. Over the last year, that's about what the economy in total has grown at. So that, to me, relative to 4 years ago, is really good. Biden inherited, and I don't necessarily credit him for this, by the way. There are just natural forces at work here, right? But Biden inherited.
Well, there's that, and there's trillions of dollars in government borrowing.
Yeah, which Trump did too, and Bush did, and Obama did before him, and so they're all equally culpable when it comes to our debt problem, I think. So if you're keeping score, let's forget about the past and let's look ahead 2 and 4 years. When the politicians ask, "Are you better off now than you were 2 or 4 years ago?" Which inevitably they will. You gotta agree on how we're going to scorekeep that. And I would prefer to use those 3 measures, even though they're imperfect. So, Trump's getting a solid handoff, if you like, Mike. I don't think there's any denying that.
There's no denying that. I think what will be a challenge is he's getting a decent handoff with an economy that's clearly not in a recession, inflation that has come way more under control than it was 2 years ago. And yet, I would describe this economy as one without a lot of slack, maybe.
Yeah, things are tight.
It's markedly better, I guess, and tighter than it was in 2016 when he last entered office.
And why do we say that, by the way? Because inflation is elevated. Unemployment's low, inflation's elevated. Therefore, things are probably tight. Sorry, I just wanted to expand
the economy's
on
already.
I want to expand on why you and I feel that way. Go ahead. Sorry.
Right. The economy's already growing at a 3% clip.
Yeah.
It was
right.
Not
Way
back
above
in 2016,
potential.
2017. And so I think we can agree. Yeah, the Trump administration is walking into an economy that is certainly not in any sort of free fall, and yet he's also inheriting one that. Arguably, who knows, could be peaking. It is at a pace at which it's going to be difficult to stimulate further when you've already got, deficit levels to GDP running at 6-7%. To spark further growth, what do you need to do? Expand that to 10%? It's a question mark that I think I have here of, yes, the Trump administration is walking into an economy that I think would be relatively attractive. And yet, it's going to be tremendously challenging to keep it going, especially if part of your goal is to control government spending and get foreign countries to the negotiating table on trade. There are the number of challenges that they are going to face here, and so that's where I somewhat take issue with this piece from Market Watch. Is you're getting handed this golden opportunity. Well, kind of, if he wants to, run the exact same economy that Biden did and grow deficits at an unrealistic pace and keep all of the, massive government handouts to green energy and stuff like that on the table, then yeah, I guess you can continue to keep pace with manufacturing. But assuming that's not what your voters brought you in for, it's going to be challenging to stimulate growth in the same way, especially with the policy priorities that you want to put in, such as immigration reform and tariff reform. So
yeah, you don't really need to stimulate growth here, to be clear. We just want to keep it growing above trend, if possible, without stoking inflation. And historically, those have been nearly impossible goals because they're in perfect tension. Don't screw it up, Mike, should be their motto. And so far, they're doing kind of just the opposite. And I'm not being critical of the ends here. I don't disagree. We need to put a stop to unfair practices by China. So we could go down the list. I don't want to get taken off track there. But it's the uncertainty that's being injected into people's decision making right now that gives me real pause.
Well, what I would like to hear a little bit more of is the honest assessment of it, of things like what Elon Musk posted to Twitter back in, I think, September or October, was basically an ask of the American public saying, look, we're trying to completely upend how we do trade. We're trying to completely upend how we do a number of different things. Government spending tends to be the one that Elon Musk is focusing on. And he laid it out pretty clearly. It's going to be challenging, messy, and might be painful for a period of time. And I think that's the part that I think the Trump administration is having a tough time admitting to is, hey, we can pull off all of this massive change without asking for any sacrifice from equity markets or the overall economy. And the reality is, if you want to deport a few million people, completely change how we do immigration in this country, upend how we do trade, get China to the negotiating table, control inflation, and cut taxes, which, those have all been, I think, big things that the Trump administration has promised. You're not going to be able to do that without some sacrifice.
No, you can't have all those things, right? You can't have high growth, a weak dollar, low interest rates, and maybe I'm leaving out a few things because, again, these outcomes are not compatible. These goals are in nearly perfect tension. Some of the explanations as to why get a little too abstract. We don't need to get into them. Just to take our word for it. These outcomes are in tension. You can't have your cake, eat it too, put some in the fridge, pull it out, and eat it again tomorrow, which is what Trump thinks.
And that's where I struggle with it is which of these are fundamentally serious, which of these are actually going to be looked at, which of them are negotiating tactics, which are, that's fine, and which of them are fundamentally unserious. I think I've come down on the Department of Government Efficiency as one of those that I would put into the fundamentally unserious categories of, these guys are talking a big game but have no real intention to cut government spending by $2 trillion because they are smart enough to know what that would mean. But there are others that I think it's an open question, and we will have to wait and see just how serious an incoming Trump administration is about things such as tariffs on Canada and Europe and deporting a number of undocumented immigrants. Things along those lines that I think could be possible, but I'm not sure how serious they're about. Let's take a quick break. When we come back, I mentioned markets opened up in negative territory. We'll have a full review of markets coming up next here on the Financial Exchange.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Heads up, athletes, coaches, and parents. Play for life, not just points. Hypertrophic cardiomyopathy, or HCM, is the leading cause of sudden cardiac death, especially in black athletes in sports like football or basketball. If you feel shortness of breath, chest pain, and fatigue, or have a family history of HCM, talk to your doctor. Don't let HCM bench you for good. Learn how to stay in the game at heart.org/HCM student athlete. Your heart, your health, your move.
Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Key Numbers to Know for 2025. Mike, when it comes to 401ks and their contribution limits, 2025 is a little bit unique in that it is the first year of the super catch-up limit.
It is, yeah. So there's a brand new contribution excess amount that you can put into your retirement plan, but only for a very specific window. You must be between the ages of 60 and 63 to participate in this special super catch-up contribution, according to the Secure Act 2.0. And so there's a little bit extra that you might be able to put in if you fall into that age demographic.
So how much is the normal 401k max? How much is the regular catch-up? And then how much is the super catch-up?
Yeah, so for the normal 401k contribution limits, the most that you can put in 2025 is going to be $23,500. If you are over the age of 50, you can do an extra $7,500 into that 401k. And then finally, if you just happen to be in that narrow band, you can do an additional $3,750 catch-up contribution on top of everything else that we already went through.
Folks, our guide this month is titled Key Numbers to Know for 2025, and this is just one of the numbers that's included in it. We also have discussions about IRA contribution limits, tax brackets, a whole bunch of different things that are included in here. How do you request the guide? Call 800-393-4001. That number again to request the guide is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, there's a lot of red on the board right now. The Dow Jones is down over 415 points, just under 1%. The S&P 500 down 84 points, 1.4%. The NASDAQ is down over 426 points, or 2.13%. The Russell 2000 down 34 points, or 1.5%. The VIX up 23.35%. Honda's U.S.-listed shares continue to advance after Honda officially began merger talks with fellow Japanese automaker Nissan. The stock is currently up 1.5% and was last on pace for a 20% weekly gain. Toyota Motor shares are up 0.5%, extending the nearly 9% gain seen in the previous session. Earlier this week, Nikkei, citing an executive who asked not to be named, reported that the Japanese automaker is aiming to double its return on equity to 20%. MicroStrategy shares are down 3%. And that comes after the price of cryptocurrency had earlier advanced to $96,000, but it has since fallen to $92,000. This comes a day after crypto markets were under pressure. During that trading session, MicroStrategy fell 4.8%. GameStop stock is down 5.85%, reversing the gains seen in the previous sessions. Shares of the video game retailer had been on a 5-day winning streak and have surged more than 88% this year. Red Cat Holdings shares are down 8%, which is stopping its massive run from earlier this year. In 2024, the drone stock has gained nearly 1,424%. The stock had also risen about 14% month-to-date amid a broader rally in the category as drone sightings across the Northeast spurred retail interest in the sector. I am Ben Kitchen, and that was...
Mark, there's one more piece here from Mohamed El-Arian before year-end criticizing the Federal Reserve. I can't think of any author who's been published quite as much as El-Arian over the last 2 years to 3 years, and has been consistently critical of the Fed, that the job that the Federal Reserve is doing. In terms of the Fed's next year meetings, right now the benchmark interest rate is sitting at 4.25% to 4.5%. When we take a look out at their first meeting of the year, which will be end of January, according to the Chicago Mercantile Exchange, there's about an 89% chance that they keep those rates exactly where they are. If I fast forward now and go look at the end of 2025, just to give you a semblance of where investors are betting on rates, they put the Fed's benchmark rate most likely outcome sitting only 0.25% below where we are today. There's about a 1 in 3 chance that that's where it stands. There's an 84% chance that we are lower than where we are today. And that means there's about a 16% chance that rates don't actually move down at all through the course of the year. Interestingly, no probability of a rate increase come 2025. And to me, that is a possibility, albeit a small one. But nonetheless, that's kind of how things are shaping up here. In terms of the 10-year Treasury, we've been talking about this spiking. It's not moving around today, but sitting around 4.58%. And we've talked about what that's done to mortgage rates, which are now sitting above 7% on the 30-year fixed, a little bit higher on those jumbo rates. It does start to big questions of what the Fed's policy is going to look like next year. And maybe you can summarize for me what you think L-Arian's, I guess, problem with Jerome Powell and their way of doing things over the course of the last few years has been.
Yeah, I can summarize it.
Go ahead.
Yeah, he's pissed. He's pissed because of their inconsistency. It's frustrating to him and Jason Furman, whose commentary in the Wall Street Journal we talked about yesterday. They want coherent thinking. They want a framework. This is what happens when Jerome Powell is a smart guy, but he's not a trained economist. And I'm sorry, but when you're running the world's most important economic institution, you need a little bit of training. You at least doesn't mean you have to go get your master's or PhD or whatever, but you need a framework. That framework will help you organize your own thinking. It would be like if you're a carpenter, you don't just jump into a job. You get the lay of the land, you do a draft, maybe only in your head if it's simple, maybe on paper if it's complex. You follow a process. Powell has, personally I mean, no process. The economists working for him do. They have a framework. They know about inflation unemployment trade-offs. They have ways to model those. They know what the errors in the predictions of their models are. It's clear, Mike, particularly from his last press conference, which I think could be fairly described as pathetic, it's clear he doesn't have a framework. At times he's saying policy is restrictive. At times he's saying they may have to wait and see. Those two statements are contradictory, yet he utters them within minutes of each other in some cases. And Furman made the point yesterday, and L-Arian makes the point today that relative to where we thought we'd be a year ago, where the Fed thought we'd be, growth is higher, inflation's higher, unemployment's lower. So why, in God's name, are you easing? Nobody understands why. We need a framework, which is what...
I think it could be justifiable to ease, but to ease more than you were anticipating doing at the beginning of the year under tighter conditions.
But wait, why though? Why is easing at all justifiable? Forget about what they thought a year ago. I'll forgive them for not getting that right. But why, given where unemployment is today, inflation is today, the direction of inflation lately, why is more easing called for? There may be a good reason, Mike. If he shared his thinking with us, if he shared his little mental model, I don't mean little as in he's got a little mental model. I just mean a simple mental model. If he had one in mind when he was communicating, it would allow him to be clearer, and people like us, and more importantly, luminaries like Furman and Mohamed El-Arian, to be less frustrated with the process. This is why Furman called for what he did yesterday in the Wall Street Journal. And I'll say again, coming from a slightly left of center guy, I think that's a really big deal.
Now, let me play devil's advocate for a moment here and evaluate El-Arian's background and, money manager for PIMCO, money manager today, or at least, economic advisor to Allianz. How much of this just comes from a place of, hey, my job requires me to better understand what you're doing, and I'm getting frustrated because you're not giving me enough clarity? And how really important is that? I mean, we talk about how the economy is constantly evolving. The last thing that I would want out of the Federal Reserve is one that are so tied to their own beliefs about a forecast that they're unwilling to bend and change with incoming economic data. Don't you run the risk of doing that if you are beholden to some form of vision of the future?
Sure. So you make sure that you're not rigidly beholden to it. When Furman yesterday writes about using a Taylor type rule, he didn't say, and here's the one you should use. There are a variety of specifications out there. You kind of take an average, much like you and Chuck Zada do when you're talking about inflation. You talk about headline, you talk about core, you talk about median, you talk about trimmed mean, you talk about sticky price inflation, and right on down the line. And then you take sort of a mosaic. You step back, and what are all these things telling us? It's not a rigid approach, Mike, but it does keep you somewhat disciplined so that you're not vacillating wildly, or oscillating, I should say, wildly, from one end of the range to the other. It's a tool meant to discipline you, not to dictate outcomes rigidly.
Let's take it a step further then. Is this Federal Reserve's failing in that category genuinely a risk to U.S. exceptionalism? Like, all else equal,
long term, yeah, okay,
it is. So because we had a wild Wednesday trading last week, which I will largely blame on Jerome Powell, because markets were completely flat when they released their policy. It was only once he started speaking that they became pretty wild. Like, where does that threaten U.S. exceptionalism?
Long-term growth depends on credibility of institutions and the stability that good institutions engender. So erratic tariff policy is a threat to short and long-term growth. Erratic monetary policy is a threat to long and short-term growth. Presidential meddling in the operations of the Federal Reserve is a threat to long and short-term growth. Maybe that's why volatility is ticking up over the past couple weeks. Markets are realizing, oh crap, this is all about to get very real. And by that I mean a new regime whose processes, whose thoughts are, shall we say, still in formation. So yeah, Mike, it is a threat to our institutional stability and the standards of living that we've been able to achieve as a result of that. I think that's what he means.
Yeah, I think that's well put. Let's take a quick break. When we come back, I want to talk a bit about a new area of lending in the market. Private credit has taken a massive role where banks used to fill a lending void there. It's grown substantially and being talked about a little bit more in terms of a risk factor. I want to discuss with you, Mark, just where those risks lie, and is it something that everyday investors need to actually worry about? Quick break. We're talking private credit next when we return.
The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network. If you're retired or nearing retirement and haven't done your planning yet, you could be missing out on opportunities that can save you thousands of dollars. Cushing & Dolan are experts in elder law and taxation, and they have a new guide out this month called Balancing Asset Protection and Avoiding Estate Taxes. Early estate planning can have many benefits, especially if you want to protect the assets. But there's another big advantage. Doing your planning the right way might also help you eliminate your estate taxes. Learn how to keep your assets in your family and avoid probate. Get Cushing & Dolan's brand new guide called Balancing Asset Protection and Avoiding Estate Taxes. Call right now, 866-848-5699. That number again is 866-848-5699. Or you can request your guide online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Financial planning is a year-round job, and with 2024 coming to an end, now is the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide may help you understand some key numbers that could affect your planning next year. There are many important topics to review, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, the guide also focuses on the many ways that the government taxes your Social Security benefits. Take the time now to reflect on your current strategy so you can be fully prepared for any adjustments you may want to make in the future. Get your copy of our new guide, Key Numbers to Know for 2025, by calling 800-393-4001. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there are some high net worth clients that would like to reduce the size of their estate, but they don't want to give up access to their assets. Is there anything they can do?
There certainly is, folks. So this is a combination of things. One, you obviously want to do your basic estate planning first. Get your foundation in place, the basic revocable trust planning to help utilize whatever exemptions you don't use up through gifting. Now, when we talk about reducing the estate, we are talking about gifting. But as you said, they don't want to lose control. So there are these special trusts that are designed called spousal lifetime access trusts, where in essence, you use an LLC to keep control of the investments, manage the investments, and make distributions. And then the non-voting shares get put into these irrevocable trusts where you have each other's spouse has access to the assets. So there's a way of getting the assets into those irrevocable trusts, which are now growing outside of your estate tax-free, while at the same time working together to keep control and use what's in those trusts.
The law firm of Cushing & Dolan have been helping families like yours for more than 40 years. Request your copy of Todd's brand new guide called Balancing Asset Protection and Avoiding Estate Taxes by calling 866-848-5699. That's 866-848-5699. Or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. If you missed any of today's show, catch up whenever you want on our YouTube page. Find daily show segments and full shows. Just go to youtube.com and search for The Financial Exchange. This is your home for breaking business and financial news. This is The Financial Exchange Radio Network.
Mark, piece in the New York Times this morning. Wall Street minting easy money from risky loans. What could go wrong? If you're not following this closely, you probably need a little bit of a backstory on all this. So, Great Recession, banks underwent a whole bunch of new regulation that didn't necessarily force them to jettison these businesses, but big banks took a large step away from issuing loans to smaller businesses, risky types of loans to struggling companies. They had done some of that leading up to the Great Recession, but largely stepped out of it. And since then, a kind of newer industry has popped up in the way of private credit. And maybe you can, Mark, but you kind of summarize what they're doing and how they are filling a void. Because as we talk about frequently, risk never leaves a system. It just moves around in some way, shape, or form. And this time it's migrated from a lot of large multinational banks to private credit companies that issue loans in a different type of fashion. Yeah,
that's exactly what it is. And it's been around. It came into its own after a little bit before and then after in force, the global financial crisis of 2008, 2009, when banks tightened up their lending. Private lenders stepped in. And a private loan is exactly what it sounds like. It's negotiated between two parties, and it doesn't end up traded on an exchange like a bond that might be in your bond fund in your 401k. When AT&T needs money, they go to maybe Goldman Sachs, and Goldman Sachs writes up the terms and then presides over the issuance of that bond and places it with Franklin Templeton and T. Rowe Price and Fidelity. Very straightforward. And then you and I buy it through our 401k, for example. Private credit is very different and also now potentially bigger than public credit. Who buys these things? Pension funds, endowments, sophisticated institutional investors who have the resources to do the due diligence. It's a big asset class, Mike. Sometimes this is called the shadow banking system. And it actually contributed to the collapse in 2008, 2009, because it's pretty lightly regulated. So it both fills a void and adds to volatility during tough times, potentially.
Now, like we said, these companies were going to find access to credit in some way, shape, or form. It just happens to not be at the banks. And frankly, that was part of the goal of Dodd-Frank regulations. Hey, we know this risk needs to exist somewhere. We just don't want it at these systemically important large banks, which when they fail, the entire financial system comes crashing down around them. So to some of this, I say this is a success story, though, as the New York Times asked, what could go wrong? Well, I do wonder about the eventual ramifications of when we have the next recession and this credit dries up, what sort of problems you have, because it's not a heavily regulated sector and it's not getting a whole lot of look from regulators. But again, I wonder if this is actually a success story of, hey, we've cordoned this risk off and it still exists, but it's not at least being held by the general public that's going to require a bailout during the next recession. Or is it? Or are we just going to bail out all these insurance companies and pension funds that are now taking all the risk with the private credit companies instead of the banks?
Yeah, I haven't thought about that enough to tell you the truth. But right now, much of it is beyond the reach of regulators, thus the name shadow banking.
Yeah.
I mean, from my point of view, it's a useful tool. But go ahead. Sorry, Mike.
No, I think I always try and bring it back to the individual investor out there who's looking at all of this, and the downside here is you haven't been able to get this type of exposure as an individual investor by and large. Some accredited investors, larger investors, are able to go place money in private equity funds, but largely they have big minimums and long hold periods and all sorts of stuff. But again, that's kind of by design, and one would just hope that if it does all blow up in our faces down the road, that, pension funds and insurance companies end up taking a hit and we don't need to go bail them out, because that was the point of Dodd-Frank regulation.
The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you, so head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Mark and Ben, I have a funny story for you. So the state of New York, and specifically the city surrounding Manhattan, New York City, spent some $500 million over the last year buying up and installing a bunch of equipment in order to start tolling people for congestion pricing entering Manhattan. And it's been like 6 months since they planned on starting this, and they still haven't collected any tolls because it keeps getting headed off in court, which I just find to be a hilarious waste of money so far. But here's what New York City is attempting to do is they have already, by the way, installed cameras on pretty much every way that you can get into Manhattan. And they're intending on tolling passenger cars $9 to enter Manhattan during peak hours, $12 by 2028, and up to $15 come 2031. The rate will be higher for cargo trucks, anybody moving products in and out of Manhattan. That will be more expensive to do for the trucks. And the idea here is, hey, fund the MTA further, punish people for coming into the city of New York via vehicle, and make it more reliable and affordable to do so via train. And it's been held up for several months with court battles, and then the governor saying that she didn't want to do it, and then won re-election and now says she does want to do it. So it looks like it's heading to that area. And from a economic standpoint, I think this makes all the sense in the world. I don't think it really would work in the Boston area where you and I live, Mark, and Ben live. But from a general standpoint, you want fewer cars in the island of Manhattan. The question is how much waste comes to play here. But it'll be an interesting, just kind of economic look in terms of how well does this work. Do people actually drive less into the city of New York? I don't know, Mark, if you've thought about this or looked at other cities and states that have implemented peak congestion pricing for things like this.
No, sorry, didn't. Nothing to add.
Fair enough.
I'm interested, though, like you, in how it's going to turn out to be a neat experiment.
Markets remain in negative territory. NASDAQ leading the way down off 360 points, 1.8%. We'll have a full market recap for you and more. Stay tuned for the second hour of the Financial Exchange up next.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM, Concord, Boston. The Money Matters Radio Network. Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
Hi, this is Chuck and Mike from the Armstrong Advisory Group. Our guide this month is titled The Key Numbers to Know for 2025. Mike, one of the questions that we get asked quite often is, how much can I gift in any given year without having to file a tax return or pay any tax on it? What does that number look like for 2025?
Yeah, there's a tremendous amount of confusion about this, Chuck. I think there's a lot of folks who assume that when you give a gift or receive a gift, there's taxes due at the time. And that is almost never the case unless we are talking about tremendous dollar amounts.
Sure.
In 2025, the gift tax exclusion amount is going up to $19,000 from $18,000. That means that you can give up to $19,000 to any individual without having to file the special return of a gift.
What about if I am trying to make a gift in conjunction with a spouse? How does that work in terms of what we're able to do?
Yeah, I mean, you're able to double it immediately, right? So that $19,000 gets doubled. Keep in mind, too, that these are the gift tax limits per individual. And so you have seen people say, okay, I'm going to gift money to my son, my daughter-in-law, their 3 children. And in each of those cases, if you are married, that could be $38,000 per person without even have to file a tax return.
Our guide this month is titled The Key Numbers to Know in 2025, and it covers these numbers and a whole bunch more that can help you optimize your financial plan. We also have discussions about IRA contribution limits, tax brackets, a whole bunch of different things that are included in here. How do you request the guide? Call 800-393-4555. 800-393-4001. Again, that number is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
Heads up, athletes, coaches, and parents. Play for life, not just points. Hypertrophic cardiomyopathy, or HCM, is the leading cause of sudden cardiac death, especially in black athletes in sports like football or basketball. If you feel shortness of breath, chest pain, and fatigue, or have a family history of HCM, talk to your doctor. Don't let HCM bent you for good. Learn how to stay in the game at heart.org/HCM student athlete. Your heart, your health, your move.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Mike Armstrong and Marc Fandetti.
Oh, good morning and welcome back to one of the final shows of the Financial Exchange prior to New Year 2025. And we've got markets that are ugly out there. The NASDAQ off now 397 points, close to 2%. The S&P down 83 points, 1 1/3%. And the Dow Jones Industrial Average off 427 points, or 1 full percentage point. The Russell 2000, if you're looking at it, off about 1.5%. Yield on the 10-year Treasury moving up slightly again to 4.59%. And Mark, I don't know, is there a big economic data point, a jobs report that we've all been waiting for this Friday, December 27th, or is everybody just working off that Christmas hangover on this Friday? I don't see much out there that would be potentially causing this sell-off. So I tend to not read too much
No,
into it.
well, there's the tariff story that we led with in the last hour, and we might talk about again in this hour. It could be dawning on people that these tariffs, if implemented as is being suggested by the incoming administration, could be really disruptive in the short term. Maybe that realization is dawning. I don't know, Mike. I'm just grasping at straws here. Like you said last hour, movements day to day tend to be pretty random.
They do, and regardless, I think that, don't read too much into the single-day move. I have a tough time believing that everyone woke up on Friday, December 27th, and said, oh, God, there's going to be tariffs in 2025.
Trump
I better sell all of my stocks. I forgot about that a month and a half ago when we learned that Donald Trump
the rhetoric on behalf of people that do the purchasing for companies that use a lot of intermediate imported goods in their processes, the rhetoric is heated up. It's more alarmist. This could just be Bloomberg's agenda, and they have one like everybody else does. But the level of panic seems to be escalating.
I want to talk about one area of the market that has had an outsized year this year, airline stocks. In spite of, let's see, a door plug blowing off an Alaska Airlines flight, Delta having to cancel thousands of flights due to a massive IT outage, Spirit and JetBlue Airlines getting blocked in terms of their merger deal, and Southwest facing an activist investor that they've had to change things on. The S&P Super Composite Airlines Index, I don't know what makes it a super composite, but nonetheless, that's jumped 60% in 2024 compared with just a 27% gain for the overall S&P 500. And you see airlines out there that have had a hell of a year. United Airlines in particular, top performer for the year, up 144% this year, making it the fourth biggest gain in the S&P 500. I don't follow United Airlines particularly closely. I don't know what caused that in particular, but you have seen a trend in travel this year and last year of folks saying they're making up, it was the making up for last time during COVID of I couldn't travel. But there's been a continued push through 2024 of not only do I want to travel, but I want to travel in comfort. I want to pay for that larger seat. I might be willing to shell out for first class. I'm certainly going to pay the extra baggage fees. And that has benefited those carriers that have that type of service more than those that don't. So the Deltas, United, Americans have had profits that are expanding and growing rapidly, and some, like Southwest, were somewhat left behind on these trends. Hence, they're facing a bit of an activist situation. Looking back, any highlights for you from the airline sector in general in 2024? Certainly, you had some regulatory shifts over the last few years from the Biden administration, requiring more disclosure on fees and things like that. Anything that I didn't mention that's catching your eye in the sector?
No, not one that I follow that closely either, to be perfectly honest. It's just striking to me. Every holiday, TSA sets records for people passing through security, volume, however you want to measure it, sets records. And at the same time, negative consumer sentiment was setting records. People's behavior over the past couple of years, whether you look at stuff they're buying or experiences that they're buying, is at odds with what consumer sentiment surveys have been suggesting, and I don't know quite how to explain that.
Yeah, so Southwest, the interesting piece on Southwest, I think, will be the transformation that they undergo in 2025. They are clearly attempting a shift away from their pure play, low cost, no frills type plan that they had there that worked for them for years. But what they're experiencing this year is, look, when you have as many people as you do this year shelling out for extra fees and you don't have any extra fees, you don't benefit quite as much as the United Airlines. And so they've already announced plans to do away with their seating method. So if you liked the free for all of Southwest seating, that's going away, with assigned seating coming in July, it looks like. And that's coming from Elliott Investment Management, who's probably going to look at other things like baggage fees, like more change fees. And I think, once again, like many other industries, like the bank, when you look at, I'm going to try and make maybe a weird comparison here that's a little bit drawn out, but when you look at the top 5 banks, let's call it Bank of America, JP Morgan Chase, Wells Fargo, and Citi. Let's just look at the four because Goldman Sachs is a little bit different. But can you point to anything that truly differentiates any of them versus the other? As just the average everyday person, when you look at Bank of America versus JP Morgan Chase, do they do anything differently in your mind?
I have to invoke my usual when I don't know what I'm talking about answer, which is I don't look at them closely enough. I don't know.
Anything,
you have something in mind?
Different from you can tell as a retail consumer.
Just from that experience, I mean, I'm sure their
like,
balance sheets look different. They all have their strengths, but as I don't use any of them. I don't know what to tell you.
I think my takeaway would be when you have an industry that is as heavily regulated as banking, or as you're talking about with the airline industry, there seems to be only one model that works if you want to be one of the largest airlines out there, which is you have to cater to every customer. You have to have basically a seating chart and a way of flying that looks just like every other carrier. And Southwest for years didn't move to that method, and it's hurting them now. And so when I look at now United versus American versus Delta, like I have a preference for Delta. I've had the best experiences with them, but can I really point to any differences between them and American or United? No, I really can't. JetBlue, I used to be able to. Today, I think they look exactly like them. And Southwest, the last one that truly had a different offering in my mind, is also changing.
What are you supposed to? At Delta, we fly backwards. It's more fun.
No, but I mean, you don't think that? I think that Southwest had a
yourself?
genuinely different offering, a differentiated offering there of we don't charge change fees, we don't charge check bag
tinkering. Yeah,
we offer a generally lower price point. We don't offer our flights on third party platforms for booking because we don't want to pay them and we want to deliver the cheapest product to you. And that model kind of broke down over the last few years. It's not working in the same way. And the benefits of a Delta where they do have, if you want to fly Delta and not choose your seat and not pay for a bag, then you can buy a really
But those rules change so often. I think for retail folks doing like leisure travel, unless you're a business customer and you like your, Emperor's Club perks, for most of us, non-business traveling consumers, we just go by price, right? Price and availability. I got to be in Charlotte on day X by noon, and price American, and I'll price JetBlue. I don't even know if they fly into Douglas, but
most of us do. Yes, you're right. The vast majority of us do. However, I think the clear message from Southwest is that there's enough, and from United and Delta, who are just raking in profits, is that there's enough of the other people that might be traveling for business or for leisure who are saying, no, I'll pay the extra few $100 for that extra perk, and it is going right to our bottom lines in a way that Spirit and others are not finding that they compete with. There's other advantages they have too, right? In the airline industry, there's just so much advantage to massive scale that's probably the most important factor. But these other things where, to me, Delta has the option if you want to be the ultra cheap flyer, and oftentimes is the lowest price point. But if you want to fly in luxury to Europe as well in first class for thousands upon thousands of dollars, you can do so at Delta, and you really can't at the likes of Southwest, Spirit, or JetBlue.
Okay.
Let's take a quick break. When we come back, we'll have some trivia for you next here on the Financial Exchange.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Financial planning is a year-round job, and with 2024 coming to an end, now is the perfect time to take a hard look at your strategy and what changes you may want to make going forward. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and our new guide may help you understand some key numbers that could affect your planning next year. There are many important topics to review, like marginal tax brackets and retirement account income limits. If you're retired or getting ready to retire, the guide also focuses on the many ways that the government taxes your Social Security benefits. Take the time now to reflect on your current strategy so you can be fully prepared for any adjustments you may want to make in the future. Get your copy of our new guide, Key Numbers to Know for 2025, by calling 800-393-4001. That number again is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about estate tax reduction and asset protection strategies that can help reduce or eliminate your estate taxes. Todd, there have been major changes with the Massachusetts exemption amounts. What is the new exemption for the state? Does that mean that a married couple living in Massachusetts with $4 million in assets could eliminate their estate taxes?
So, yes, there has been some changes. Now we're almost a full year in, of course, heading into a second year into the change. The change is now $2 million. It used to be $1 million for estate tax exemption. Now it's up to $2 million. And yes, if you are married, but you actually do trust planning, you can shelter $4 million. But folks, that doesn't mean that's all you do. For folks with $3 million that want to eliminate taxes, we can do that. But we can also think about protecting assets from the cost of long-term care. It allows us to do both a little easier now with a higher estate tax exemption. So think about ways in which you can use the irrevocable trust to not only shelter and be able to reduce your estate tax by sheltering up to $2 million on the death of each spouse, but also starting that important 5-year waiting period running to protect those assets from the cost of long-term care.
The law firm of Cushing & Dolan have been helping families like yours for more than 40 years. Request your copy of Todd's brand new guide. It's called Balancing Asset Protection and Avoiding Estate Taxes. You can call 866-848-5699. That's 866-848-5699, or you can request the guide from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
All right, time now for some trivia on the Financial Exchange, and in honor of Mike being in Chicago, let's go back in time to this day in 2002. Chicago, starring Renee Zellweger, Richard Gere, and Catherine Zeta-Jones, premiered at theaters in New York City and Los Angeles. Chicago would go on to win Best Picture at the 2003 Academy Awards. Today's question, just name one of the movies that Chicago beat out for Best Picture at the 2003 Academy Awards. Just name one movie that Chicago beat out. I'll give you a hint. It was one of the Lord of the Rings movies. Be the third person to text us at 617-362-1385 with the correct answer, and you'll win a Financial Exchange Show t-shirt. The third correct response will be our winner. See the complete contest rules at financialexchangeshow.com.
We don't give hints here on the Financial Exchange, Ben. I'm not sure what you're doing there.
I whispered it. No one heard.
Just not allowed. How much more did you spend this year on Christmas, Ben, than last year, Mark? I'm not asking you just specifically because I know you didn't do quite as much holiday shopping as those with kids of their own do. But was it a big bump up year over year for you?
Absolutely, because now my son's 3, so he's in that prime age of like starting to understand Christmas. So I felt like I had to go extra big for him. And yeah, I probably went about $500 over what I would normally spend.
Well, that seems to be the trend across the country. Amidst all the bad market sell-off data today, we did get some data from Mastercard this morning, who puts together these estimates on overall holiday shopping that they're seeing. And their quotes here saying that holiday spending rose 3.8%. Apparel and restaurants leading the way in those categories in particular compared to last year. And that is, look, if you're trying to judge like how good is 3.8%, but it's pretty darn solid given this does not adjust for inflation, but it does insinuate, what would that be, Mark? Like a 1 to 1.5% increase in actual goods purchased, given where inflation has been. I don't know where like toy inflation is particularly,
that's
but
in the ballpark.
Overall inflation that puts in a pretty big increase. That's compared to only a 3.1% increase last year, so that would be 2023 versus 2022. Online shopping, as I mentioned, led the way with a 6.7% growth rate, which is accelerating from last year, which is surprising. In-store spending improved too, though. That was up a good 2.9% in-store spending. Last 5 days in particular of the holiday season accounted for 10% of the overall total spending. So we are good procrastinators, as I think everyone knows. And then apparel sales saw strength this year with sales up 3.6%. Restaurants remained very strong here. This is an interesting number to me because you do hear about a bunch of restaurants that are struggling, but overall restaurant spending remained up a good 6.3% in this holiday spending year. So, I mean, my main takeaways from this would be pretty simple. Consumers are not one bit concerned about their financial well-being. They probably should be, because our next story is about how those same consumers, more than a third of them, racked up debt in order to do what I just described. The average amount, the average balance probably on those credit cards being $1,181. This is according to a survey from LendingTree. I'm not really sure what that means. I think what I'm taking this to mean is that when you ask people, hey, are you racking up debt to do this holiday shopping season? What it probably means is, yeah, I put a bunch of stuff on the credit card and I have no means of actually paying that off next month when it comes due. Because if you just, I mean, I put more than $1,000 on my credit card this holiday shopping season, but I plan on paying it off when that statement balance is done. I'm guessing if you're responding yes to this survey, then you're saying that, yeah, I racked it up and I'm planning on not paying it off come January, which is pretty consistent with what we see on average. I think on average about half of credit card owners carry a balance on a month-to-month basis, which brings me to my overall conclusion regarding credit cards, which this is one that I've evolved over the years. Dave Ramsey and the likes have always said, like, you shouldn't have a credit card. Just cut the thing up. Don't use it because it's more of a problem than it is a benefit. And I felt differently from the beginning. I've had a credit card since I was 18 years old. I had a really small limit on that thing. I paid it off every month. I built my credit score. I got points. The more I have studied this subject, the more I've become convinced that the average person just probably shouldn't use a credit card at all, because most of them carry a balance at some point or another and really fundamentally misunderstand the power of a 20+% interest rate on those things. I'm not saying that we should ban credit cards. I am very much free market on this one. I think the fee restrictions that the Biden administration tried to put in through the CFPB are ridiculous. If you haven't seen these, it's like late fee restrictions and all sorts of things that credit cards are being restricted on now. I think that's all ridiculous. You should be able to have a credit card if you want to. But my conclusion is that the vast majority of people just don't know how to manage it and end up screwing themselves from a financial perspective.
Yeah, that horse is out of the barn. I mean, what are you going to do?
Which one? Like, you can't exactly go credit.
The charge card. Yeah, unless we're going to take our DeLorean back to 1955 or whenever the first charge card was introduced. How do you stop people unless their credit score stops them from using credit? How do you stop it? Credit non-revolving. What's it? Revolving or non? That's non-revolving, right? Whatever.
Yeah.
Stuff that's not secured and that you're paying through the nose to finance.
I think here's the overall lesson for me, though. Like, I feel as though there are a lot of parents out there who have said like, no, you should have a credit card as a teenager or a young 20-year-old. Like, it's a great way to build credit. And my conclusion is that for my own kids, I'm not giving them that message. Like, my message to them is going to be, there are other ways to build credit. Don't use a credit card until you are very certain about the ramifications of using it. And again, maybe I'm just being a controlling parent who's being a helicopter. But the lesson of, hey, no, use the credit card because it'll build your credit score. That benefit is so far outweighed by the people who cannot get themselves out of credit card debt that they are just consistently dealing with on a month-over-month basis, that I have turned my tune on that to say that for the average person, that's not good advice. Don't use a credit card until you have your finances well under control, until you have a steady income where you'll be able to pay off that balance every month. I just don't think that I can really get on board with saying, yeah, young people should be using credit cards and learning how to do that sort of thing. No. You use something else to be able to make payments digitally instead of a credit card, or if you are going to use it, then be so certain that you'll be able to pay it off every month that it's not even much of a question.
Yeah, as a rule, that's probably good advice.
That's my personal finance, personal family story that I'm going to run with today. Let's take a quick break. When we come back, we're going to have the trivia winner, but then I want to talk about a record number of Americans turning 65. It has all sorts of implications for our healthcare systems and such, but it also has big implications for the financial services industry. That's next here on the Financial Exchange.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
The Financial Exchange and Veterans Development Corporation are proud partners of the Disabled American Veterans Department of Massachusetts. The DAV provides thousands of hours of voluntary services at our VA medical centers and is the only DAV department in the country to lead a veterans housing initiative for single veterans and for those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit davma.org. That's davma.org.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Early estate planning is crucial if you want to protect your assets and avoid massive tax consequences. Cushing & Dolan are experts in elder law and taxation, and their new free guide can help give you just that. It's called Balancing Asset Protection and Avoiding Estate Taxes. In it, you'll learn how to keep your assets away from the nursing home while reducing and potentially eliminating your estate taxes. If you have an existing estate plan but aren't sure about your potential liability, or you need a new plan, call Cushing & Dolan today at 866-848-5699 and get this free guide called Balancing Asset Protection and Avoiding Estate Taxes. Don't leave your assets to chance. Call 866-848-5699. That's 866-848-5699. Or you can request your guide online from our website, LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Key Numbers to Know for 2025. Mike, when it comes to 401ks and their contribution limits, 2025 is a little bit unique in that it is the first year of the super catch-up limit.
It is, yeah. So there's a brand new contribution excess amount that you can put into your retirement plan, but only for a very specific window. You must be between the ages of 60 and 63 to participate in this special super catch-up contribution, according to the Secure Act 2.0. And so there's a little bit extra that you might be able to put in if you fall into that age demographic.
So how much is the normal 401k max? How much is the regular catch-up? And then how much is the super catch-up?
Yeah, so for the normal 401k contribution limits, the most that you can put in 2025 is going to be $23,500. If you are over the age of 50, you can do an extra $7,500 into that 401k. And then finally, if you just happen to be in that narrow band, you can do an additional $3,750 catch-up contribution on top of everything else that we already went through.
Folks, our guide this month is titled Key Numbers to Know for 2025, and this is just one of the numbers that's included in it. We also have discussions about IRA contribution limits, tax brackets, a whole bunch of different things that are included in here. How do you request the guide? Call 800-393-4001. That number again to request the guide is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Text us 617-362-1385 with your comments and questions about today's show. This is the Financial Exchange Radio Network.
All right, for trivia today, I asked you to name just one of the movies Chicago beat out for Best Picture at the 2003 Academy Awards. And I gave you a hint that Mike chastised me, rightly so, chastised me for, and only one of you got that one. But that wasn't the right one. So Joyce from Rowley is going to be our winner today because she correctly said The Hours as one of the movies that Chicago beat. Some of the other movies that Chicago beat at the 2003 Academy Awards: Gangs of New York, The Pianist, and Lord of the Rings, The Two Towers. So like I said, Joyce from Raleigh will be taking home that Financial Exchange Show t-shirt. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
A record number of Americans will be turning 65 in 2025. About 4.2 million people in the U.S. are forecast to cross that age threshold next year. And look, this is nothing new. This is, something that has been forecasted for years, and we're in kind of that peak 65 zone from now through 2027, where more than 4.1 million Americans will hit that age level every year. And among other things that it means that a number of people will probably be retiring over the course of the next 3 years. A huge number of Americans will be retiring, or at least evaluating that over the next few years. And for the financial services industry as a whole, there's a big appetite, obviously, for those retirements, because it oftentimes means people looking at and evaluating their 401ks. And Mark, I think I want to start right there for those folks that are starting to retire in terms of how they should be thinking about their own retirement plan when they get to that 65 threshold, or whatever that retirement date threshold is. It doesn't necessarily need to be 65. I think most people know at 59 and a half, you have a lot of options that open up to you. But before we go, there are some drawbacks to traditional, employer retirement plans, but there are also a lot of benefits. And, coming from that space, you used to work heavily in that space, Mark. Maybe you can kind of talk to some of those, because for all the criticisms about 401ks and, some people don't really like the system and it limits choices, there are some benefits too that people have to those plans that exist at the place that they work. Do you mind running through a few of them for me?
Yeah, what's typically cited is the protection from creditors, people pursuing you for money, that the federal law that created and governs 401ks affords to 401k participants. When you're in that kind of plan, you're called a participant, not an investor, even though we think of ourselves as investors. So if you remain a participant, there might be situations where your assets are protected, whereas under state law, which governs how creditors can get to your assets in an IRA, under state law, they might not be. So that's always worth inquiring about, Mike, and I think that's something that you would point out to a client who is asking about pros and cons of staying in your employer plan versus the typical alternative, which is rollover to a traditional IRA, sometimes called a rollover IRA, but legally, correct me if I'm wrong, Mike, it's the same thing.
Yep, self-directed IRA, whatever you want to call it. I would also say, look, at this stage of life, a lot of people are looking for additional guidance, and so unsurprisingly, that additional guidance can come in the way of a lot more in the way of fees. 401ks aren't necessarily the cheapest option out there, and the problem with them is they vary dramatically, or 403b, 457, whatever that retirement plan is, they vary dramatically in terms of cost because they can be provided by any number of carriers, and there can be high cost option, low cost options in there. Generally speaking, though, for large employers, the 401k is a relatively inexpensive option when it comes to how you invest your funds as a participant. And almost every option that anyone is going to, push you into when you retire is probably going to be more expensive because of that, because of a number of different factors. It's not always the case, but it's oftentimes the case.
Thing is, Mike, sorry, go ahead.
Go ahead, please.
I was going to say 401ks are designed for accumulation. They're designed for long-term savers needs. They don't necessarily fit well with the needs of a, say, retiree who will occasionally, maybe not necessarily regularly, be taking money out, who would like to target the fund from which they take money. This is a biggie to me. 401ks might have a money market or stable value, or if you have a option that's been around for a while, it might even be a GIC, a guaranteed insurance or investment contract, but you might not be able to opt to take money just out of the principal preservation, which is a blanket term for all of those things.
Sure.
Fund, you might be forced to take your money out pro rata, a little bit from each option, including stock funds, at a potentially inopportune time. So I think it is fair to say, correct me if I'm wrong, guys, that a 401k is less flexible in terms of distribution, that is withdrawal options, than an individual account is. By necessity, it's not built for that.
Yeah, and I think, look, all of these things are just to say that it's the average. It's not always the case one way or the other.
No, you got to ask.
You do have to ask. And the thing that I fear is that the most likely outcome in my mind is probably that we just see a continuing surge of money into annuity products, which has already kicked off. Back in 2022, individual retail annuity sales were less than $300 billion. According to Wink, which is a research firm, sales are expected to be around $450 billion in 2024 and exceed $520 billion in 2025. And it's not just that most people are, that a lot of people are retiring around this time. It's probably also that interest rates are up. But, a lot of these tend to be very high cost, complex products that people aren't familiar with. I think the key message that I have, though, if you're undergoing this transition, I know it can be sometimes scary, right? Like you're going from a position of being a saver where you have a reliable income source to maybe replacing some of that with Social Security, but maybe you're not even planning on that right away. And there's some fear built into, hey, where's my next paycheck going to come from? And I fully recognize that. And that's probably speaks to why some annuity sales have been through the roof over the last few years. My word of caution would be, evaluate this slowly. You generally can't put that money back once you've made a decision like this to roll over your retirement plan. And so be intentional. Research your options. And if you're working with a professional out there, you should be able to ask some basic questions. What's the cost difference? What other considerations should I have here? Do you, my investment person, actually believe that this is in my best interest, that I should be doing this? And would you do it for your family member, things like that? These are reasonable questions to ask. And reasonable questions to get in writing, too. Like, hey, this is how much you're going to be paying today. This is how much you'll be paying in the future. We demand that for everything else we do. And for some reason, we treat financial services differently. We just treat it as this big black box of, there's costs in there, and don't worry about those. You'll pay for them some way. We treat it like we do the healthcare industry, and that makes no sense. If you are approaching retirement and you're trying to sort out what the next step is for your probably largest chunk of liquid assets that you own, which is your retirement assets, please give the folks at Armstrong Advisory Group a call and let us help you evaluate this. We'll help you determine, hey, is this in my best interest to move this somewhere else and have it managed by somebody and maybe layer on costs that aren't necessary? Or am I best off leaving that where I am or doing something else entirely? If you haven't had those types of conversations, or if you're scratching your head saying, wow, I did this last year, but never really talked about those sorts of things, please give the folks at Armstrong Advisory Group a call and let us help you evaluate. The phone number is 800-393-4001. We offer consultations throughout New England, but we do them over the phone and via Zoom too. If you have questions and you're not able to make it to one of our offices, which, like I said, we've got 12 of them scattered throughout the New England area. That phone number, once again, to book your free consultation is 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Mark and Ben, I have just devastating news for those who like the underdog out there, might cheer on criminals. The suspected Boston porch pirate called the Tom Brady of stealing packages has finally been arrested and taken down here. So good news if you live in Southie. Bad news if you're cheering on the drug addict, homeless Robin Hood of stealing packages. Apparently, Carrie Flynn, 34, was arraigned in South Boston. I don't know how she got the nickname of Tom Brady of stealing packages, but I imagine that it was probably pretty humorous.
I think it's because she looks like the court sketch of Tom Brady from the Deflategate trial.
Genuinely?
Yeah, it was a really bad picture of Tom Brady. He looks like a bad cartoon.
If you don't know what I'm talking about, if you haven't lived in, a major metro area where this is a serious problem, like having come from Somerville back, or lived in Somerville some 13 years ago when I did not order nearly as much stuff on Amazon as I do now, stuff would disappear all the time. It was actually rather convenient if you ever wanted to get rid of, maybe you had some old furniture or just stuff that was taking up room in the basement. You didn't really have to worry about it because you just put it on the corner and it would be gone in 30 seconds, especially if you posted free stuff on Craigslist. But in terms of porch pirates, yeah, if you live in a major city these days, it is a giant pain. And to the point where insurance companies have started issuing porch pirate insurance that you can purchase and avoid or at least get reimbursed for missing packages. But this will be a continued issue come 2025. This is not going to go away.
When did we start taking for granted that we could leave valuables out on the front porch all day?
I don't know.
It says something about how evolved we are and how maybe complacent we've become. When I was growing up, you would not have done this. You would have been ridiculed, and people would have said you deserve it, and let this be a lesson to you.
Why is there an expectation that you won't get this stuff ripped off?
That's the more. When did we start to take for granted that valuable things would be safe outside all day? This is a good thing, Mike. By the way, I
just parked in my hotel. There's a giant sign that said "Park at your own risk. Take valuables out of the car." That's a pretty universal truism. Like, just don't expect that you'll be able to just leave stuff there.
Yeah, I mean, and what does that do to Amazon? I'm sure you and Chuck Zott have talked about this, but longer term, suppose order breaks down just a little bit. We can't take that privilege for granted anymore. What does that do to their little model? I'm just speaking rhetorically or just speculating.
I think it should probably shift in some way, shape. Like, it makes sense to me that you would utilize further the Amazon already has those places that you can pick up your packages, and I don't really understand. If I lived in Southie or in Somerville, there's almost no circumstance where I would say, yeah, I'm going to feel great about having this shipped to my home. Why don't I just ship it to one of those package centers instead? I can drop by on my way to work instead.
Or the post office.
I recognize there are disabled folks in other situations where that's not a possibility, but Amazon should be pushing that harder. It's easier for them. They don't have to go door to door. They can drop it off at a central location. And if they just started pushing that and just telling people like, hey, we're not going to be responsible if your package gets stolen off your front doorstep, that seems like a reasonable approach from them and a pretty easy solution for the receivers of those packages.
Yeah, because no way signing for everything works like in the very old days. There's just no way, given the volume of deliveries.
Yeah, no, that wouldn't work at all. I can barely deal with my once a quarter wine shipment that I get.
And Eric, do either of you guys let them into your garage when you're not home?
Sometimes they have just dropped packages off in the garage, and that's.
What do you mean in the garage? You leave it open?
Well, how are they getting in?
Like the garage might be open because I'm in the back.
Oh,
the garage door is open.
Yeah, that's
but
you're
they walk into my. Well, they shouldn't be walking into my garage. I have a front porch. Leave it there. You walked further to go to my garage than you did to my front porch.
Sorry, I wasn't clear. Would you open your garage when you weren't home, or would you give them a key, a digital key, to open your garage door?
Absolutely
when you were not home.
No thanks.
No, I don't think I would. I don't think I would either. No.
I don't think I would either. Walmart wants to get access to your house and put your groceries in their fridge, though. Remember that was the thing? I don't know if they ever launched that, but that was the idea is, hey, we're going to have a door code to your home. And if you order groceries, rather than them sitting out on the porch and spoiling, we'll actually walk into your home and put them in your refrigerator. To which I say, no, you will not. Let's take a quick break. Where we come back, Stack Roulette here on the Financial Exchange.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. Protect your assets and avoid tax consequences by getting Cushing & Dolan's new guide called Balancing Asset Protection and Avoiding Estate Taxes. You'll learn how to keep your assets away from the nursing home while potentially eliminating your estate taxes. Get yours today by calling 866-848-5699. That's 866-848-5699. Or request it online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
The U.S. Virgin Islands are St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way, so whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck Zada from the Armstrong Advisory Group. Your lifelong financial plan should always be top of mind, and as another new year approaches, now is the time to review some key numbers that may affect your strategy going forward. Our guide walks you through several important numbers that you'll need to be familiar with for 2025, especially from a tax standpoint. It's called Key Numbers for 2025, and in it, we'll explain marginal tax brackets for both married couples and single filers, as well as information about the standard deduction that'll be pivotal for your financial planning strategy. We'll also explore other areas like the federal estate tax and gifting limits. Call us right now at 800-393-4001 and ask for your free guide today. That's 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
The Financial Exchange is proud of our partnership with the Disabled American Veterans Department of Massachusetts. This year's 5K was another tremendous success. Every dollar raised supports a wide variety of initiatives like the DAV Transportation Program, which takes disabled vets to important medical appointments that supply both the physical and mental care they need. If you'd like to help our great American heroes this holiday season, visit dav5k.boston and make a donation today. Thank you again for your support.
Time for a bit of Stack Roulette. What do you have for us today, Mark?
This is from CNBC, Mike, and Ben. Mega Millions jackpot is the headline. Climbs to 1 point. I'm going to round up and call it $2 billion. Here are the 8 states. CNBC helpfully points out where your prize won't be taxed. And they're just I'm not going to get into detail here. I don't think it's necessary, other than to point out a couple of surprises as to where lottery winnings at the state level, always taxable, right, Mike, at the federal level? Can't get around that. Okay. So state level, California doesn't tax lottery winnings, which surprised me a little bit because they're big spenders.
That is surprising. One of the highest tax states in the country saying, we're going to exempt lottery winnings. That's a weird choice.
And Washington State has no state income tax, though I think of them as a high tax jurisdiction in other ways, but they don't tax lottery winnings either. So a couple surprises on the list, but Mike, it's not like you could, change your residence at the last minute if you thought you won. I assume they time keep that as of the time of the drawing, right?
I would think not. And I also don't know. I assume all of this is taxed as where you're a resident, but if I go and buy a ticket in Illinois and win, I assume Massachusetts gets the revenue since I'm a resident there, even though I bought the ticket in Illinois. That
was one of my questions to you, as one of the state's most prominent financial advisors. So if you're asking me, I'm going to cross that one off the list.
Yeah, unfortunately, if you're looking for expertise on the Mega Millions jackpot and where you will avoid the most taxes, I guess I am not the financial advisor for you. I do not have any clients who are $1.15 billion Mega Millions.
So can I ask you, do you have a philosophy, Mike, lump sum versus income stream? On these suckers, have you ever been asked, like, by a lottery winner?
I here is where my only perspective on this would be, because I do get a lot of enjoyment about dreaming up what if I won one of these things. I think about all of the stupid financial decisions that I've made over the course of my life, and I just think that I'm generally not any smarter than anybody else, and so I think that if I were to win something like this, I would want to take the annuity, not because I think it's a better investment deal or anything along those lines, which you could argue it might be, because the reason it's $1.15 billion, by the way, that's the annuity payment that you could receive. And it's only higher because interest rates are higher right now. They basically buy treasury bonds to pay this thing out over a period of time. And so that's why the jackpots these days have been much higher than previously, because interest rates are higher. But I just think that would limit the stupidity that I could take over the course of winning this money. Of course, nobody actually takes the annuity. Everyone takes the lump sum, and a large portion of them do end up broke. And so that would be my way of saying, hey, I will probably make some mistakes with this money. I've made mistakes before in my life, and I'm going to continue to be susceptible to it in the future, and thereby not being able to blow it all at once. It would be my method to prevent it.
Let me just tell you, the state you're in right now, Illinois, this is why you always take the lump sum. Illinois lottery, I think it was 2015, went bankrupt and stopped paying out lottery winners. That's why I would always take the lump sum instead of the annuity.
Okay, fair enough. Good perspective there, Ben. Dow, S&P, and NASDAQ all strongly in negative territory as we close out one of the last few trading days of the year. NASDAQ leading the way, off more than 2%. That is all the time we have, folks. Have a great weekend. We'll be back at it on Monday, and happy holidays.